So we just finished our investor update for Commune. And after we were sitting here kind of talking about, stock market and inflation and everything everyone's talking about as it pertains to money. And Jerry was speaking, and I was just like kind of, staring, listening to Jerry. And then I looked at, our filmers, they're doing the same thing. And I just thought, this is probably a conversation that we should document. So this is fully just like off the cuff. I think it's going to be interesting. So why don't we just start with what's going on in the stock market? It's moving right now. What's the reason for it? Who wants it?
I'll give some of the elements that I'm seeing, and then if you could add to it if you want.
Yeah, I'm going to say jump in and speak as much as you want, and I'll throw in what I have to offer.
Yeah, I think the markets, they're reacting as they typically do to events around the world. And I think what we've probably seen in the last few weeks is function of inflation and the reports we've seen on inflation. Some of this advancements of Ukraine and Russia and their potential conflict. The Fed effectively announcing their reduction of, buying $120 billion of bonds, kind of on a month in and month out basis. And you have some companies that release quarterly earnings that were disappointing, and they had underperformed. And one of the analogies I had heard early on in my career was that the market volatility is like your blood pressure. When there's anxiety and fear and concern, it goes wild. And I think that's by and large what we saw. I don't know if there were other variables that you noticed.
Any of those events by itself would be expected to trigger, a little bit of a pullback, and we call them, corrections in the market. And we tend to see, roughly a 10% pullback in stock prices off their peaks, with fairly high frequency. It's once every year to 2 years it happens. So that's a really regular event. And that's really about all we've seen here. In fact, it hasn't even quite gone that far on the broad market. Some sectors have been worse than that, but broad market hasn't been even that bad yet. So I would say the market's reaction to all of those things combined has been fairly muted. So that's not a judgment. It's not that's neither good nor bad. It's just, just is.
I did a poll last week and just asked, how many of you guys are holding and how many of you guys are selling? And it was about 90-10. 90% were holding, the other 10% were selling.
Did you ask how many were buying?
The majority of the people that were holding did mention this is a buying opportunity. So that's a good sign. For the people that are selling, the 10%, what do you say to them?
Well, it depends on why.
Okay.
Yeah.
That's actually a really good point. For the people that are selling out of fear, what do we say to them? Because the other ones, the conversation is more, are you in a position where you're forced to sell? And if that's the case, what could you have done to not put yourself in that position, right?
Yeah, I'd say fear and greed are extraordinarily powerful motivators, and probably some of the worst motivators that you could act on. And so I think it was Warren Buffett said, I want to get greedy when others are fearful and fearful when others are greedy. So thinking a little bit contrarian there is a healthy thing. When everybody else is selling with reckless abandon, that's the time to be a buyer. When everybody's saying, oh, Goldilocks, everything's just right, chances are some volatility is coming, and things are going to get mispriced, and that ends badly. So bad news is our friend, okay, to a large degree as an investor. If you can take a step back and say, okay, set the emotions aside for a moment. Is everything going to be okay? Maybe stock prices go down a little bit, who cares? I'm in this for the next 20, 30 years. What's it look like out there, okay? Are people going to stop buying stuff? Maybe they buy a little bit less next quarter, but I don't care about next quarter. 30 years from now, do we have fewer people or more people in the world? Are they buying more stuff or less stuff? Are people generally getting wealthier or poorer? Well, all of the answers to all of those questions are positive. And so, I don't worry too much about, the news. So geopolitical geopolitical risks, whether the Fed's going to raise interest rates or lower interest rates, what's inflation, all of those things get worked out over time. And so being an investor that it has a discipline of consistently saving, consistently adding, and that's how you make money long run.
I would add to it that an investor who sells out of fear probably didn't do enough in the planning stages before they got into the market, or while they were in the market and the market was performing well. They probably rode the wave longer than they should have when they either knew or they were being told, you've had some material gains on some of these positions. Now it's time to sell and kind of rebalance your allocation. And they chose not to do it, whether it's because of the tax implications or the fact that they felt like it was never ending in the amount that it would increase, or whatever the case may be. Or they didn't have enough of a cash position to be able to leverage a downturn. All of a sudden, what you've grown accustomed to effectively for the last, what have we gone, almost 13 years now, since 2008, what you've grown accustomed to is all of a sudden shifted, even though it's a very small blip, right? You look at the market since 2008, you're still on a significant upward trajectory. But when you live in that moment, you haven't done the planning and created what I will do in these situations, it's very quick to act on that kind of emotion. And that's oftentimes where you see people make the biggest mistakes. However, it's also where you see the opposite, the people that did plan. And the people that knew exactly what they were going to do when that market went through that correction are the ones that are celebrating right now and will continue to do so because they identified the opportunity and they executed upon that position to buy. When we've talked about this before, when a clothing store has a sale, the prices are down. You buy, right? Like you go to the store, you go to the sales aisle and you see the things that are on sale and you typically want to buy. You're buying low. Right. When things are full price, maybe you don't necessarily buy. For some reason, we have an inverse relationship with the stock market. When things go down, we retreat.
Yeah, because it's not easy to do, right? Like a lot of times you're watching your future in a, maybe it's not realized, but you're going, oh my gosh, my future's at risk, right? So learning, it's not even learning, it's really creating the discipline to follow the plan in the times where it's scary to. Over time, you really start benefiting from it, right?
And that discipline also, it definitely applies in good times as well. If you buy something at 10 and it goes up to 100, if that shifts your asset allocation and tilts you heavily to equities, well, then you need to rebalance, and that means you need to sell. So the opposite of selling when you're low is happening there, where you realize that your position is higher and it is time to exit. Right. Sure, you'll incur some, tax. You're still ahead. Right? And more importantly, you're aligning your investment strategy with your risk profile. Right. It's not easy to do, though.
No, it's not. So what I think the biggest hot topic is right now, which is the Fed and interest rates and inflation. But in this moment where we saw, the Great Resignation, and we saw the Fed, our last conversation, they kind of mentioned that they were going to put all of their focus towards GDP growth and they weren't so worried about inflation. And then inflation ran up, and now all the headlines are, 1982 style inflation. What's in front of us, Chair? What are we seeing? Because their tone did shift, correct?
Yeah, and that's, so back when we had our last conversation, everybody was, kind of saying, we've been in this long period of, below trend inflation. And inflation's not an issue, and a lot of people missed that message change that you talked about, where the Fed said, okay, we're more concerned about the economy and employment than the rate of inflation, and that was key. That was a really important thing that they said, because that's basically warning you, hey, we're going to let inflation go a little bit, and they did. And now, of course, everybody is looking out there and saying, okay, well, inflation, and they're starting to change their expectations about what inflation is going to look like in the future. Meanwhile, the Fed has reverted back to their traditional messaging of 2% inflation. And they're
By 2023.
yeah, by next year,
Nonetheless.
no less. And so they think their messaging is saying, we think the economy is strong. We think it's strong enough to support us combating inflation. We think the employment situation has largely resolved. There's still, issues to work through, but they think it's strong enough to, start shifting their focus back to fighting inflation. And that's, again, significant. There's an old saying: "Don't fight the Fed." Don't fight the Fed. And that largely came from. Well, going back to Bernanke, as a Fed chair, he was saying how he thought his vision for the Fed was, we need better communication. We don't want people guessing what we're going to do. We want to broadcast it in advance and then act on what we say we're going to do. So that way, nobody's wondering whether we're gaming the system or what. We have full transparency. And that's worked. That's brought in a regime of very low interest rates, partly in response to Fed action, but partly in response to the U.S. is still perceived as one of the safest places to invest your money, in U.S. Treasuries in particular, because of this expectation that the Fed's going to let everyone know in advance what it is they're going to do and how they're going to do it, and then they actually follow through on that. And so betting against them is a dangerous proposition. There may come a day where they can't actually fulfill a promise, but I really don't think we're there yet. So, when we ask the question of what's coming for inflation, that's kind of the philosophy that I'm looking at for answering that question. If they're saying that they're going to rein it in, I believe them. Whether they'll get there in 2023 or not, whether they'll hit 2%, okay, there may be errors in the margin there, but thematically, that's where they're going. And so, unless something significant changes in the economy, I do think that their focus is going to be on reining inflation back in, and I think they have the tools to do it.
Okay, so then if we're not betting against the Fed, we are expecting interest rates to rise at a level that will bring inflation down. How does that affect everybody? Or actually, more specifically, how does that affect real estate? How does that affect the real estate investor?
It depends. So it depends on how much tightening ends up being necessary. So
right, but if we're talking about capturing inflation, significant tightening is going to happen? Or do you think we can get from the 7.5 back to 2 pretty easily?
That really depends on. I don't have a good answer for that. Okay, there's a lot of things that are different that means we're low confidence in those forecasts. Okay, there's a lot of variable rate debt out there. Okay, so when back in most of the models that look back on history and try and predict based on what happened before what'll happen next, you have sensitivity analysis that says, okay, if the Fed raises rates this much, it does this to the economy. Well, just the change in the amount of variable rate debt that has happened, I think really changes the impact of. I think it takes a much smaller move in interest rates to get the impact looking forward. So I don't think that interest rates have to go as high.
Like they don't have to do what they did in the 80s.
I don't think so. And again, there's big differences in how they view the problem versus how they viewed it in the 1980s. Having said that, one of the things I was touching on before we turned the cameras on here was the difference in what happened in the 2008 financial crisis and what happened in the COVID environment. And why the economy is behaving so differently. And 2007, 2008, in the financial crisis, the Federal Reserve said, okay, we're going to take interest rates down to zero. We're going to use every tool we have, but it's not going to be enough. We need Congress to act, and get fiscal policy engaged and increase spending and stimulate the economy that way. And of course, we had a gridlocked Congress, with the Tea Party movement and all of that. They just couldn't get spending passed, and the spending that did happen was grossly insufficient. And so the result of that was, the Fed actions, they implemented quantitative easing and some other tools that they added to the tool belt to try and get things turned around. But it took a really long time, and inflation didn't really become a problem. Well, this time around, of course, fiscal policy has been,
through the roof.
total opposite.
Right.
If potentially way too much additional spending, and at least for the moment, that remains an issue. We have still a very high spending Congress, and still trying to spend more. And so the result of that has been rising wages, and we talked about in our last update how rising wages creates a significant amount of inflation pressure, and how when you start with the minimum wage and people at the entry level, and how that kind of rolls up through the ranks. Well, we've seen that. It's happened, and so you have more dollars chasing the same amount of goods being produced, or actually fewer goods being produced. Prices have to go up in response, and so while we're in that environment, we have a Fed that's going to be fighting against that, and so it kind of puts us in the opposite situation of where we were in 2008, where the Fed is tightening while Congress isn't quite, hasn't indicated yet that they're on the same page. Hopefully they will, but that's a big variable that we have to keep an eye on, as we look forward. I do expect everybody looks at this inflation problem and says, regardless of the political rhetoric, nobody wants inflation. Right. Okay, so I do expect that they will come around and do what's needed. And some of the things, tax hikes and things like that's massively, tightening. So, some of those things that have been proposed over the last year, some of those will resurface, I'm sure. So the tools are there. They have the ability to do it. The Fed is on board and saying, we're going to do it, watching for Congress, seeing whether they do or not. Depending on what Congress does, that's going to have a big impact on how much the Fed has to tighten. If Congress starts cutting spending, I don't think you see interest rates move much before before it has a significant impact. If they don't, they'll have to raise more. I still don't think it looks anything like the 1980s, though. I think at this stage, we have...
We're not seeing double-digit interest rates.
Well, we're not seeing double-digit inflation
That's
yet.
true, that's true.
And at this stage in the 1970s, the U.S. was still in denial. Okay, I mean, we didn't have a problem yet.
Right.
At least not when we were willing to do anything about it.
Right.
And so, it really took inflation getting up into those double digits before we had the political will to do something about it. And this time around, I think the political will, the memory is there of what happened last time. And, we're hearing that the wheels are in motion to start, reining that back in. And, the Fed's making good on, what they said in that, they said, okay, we'll let it go a little bit, but we still want that 2% average. We're willing to let it go a little bit because we were below for so long, but we're not going to let it go forever. They're making good on that, or at least they're saying they're going to. So I think it's reasonable to assume that we don't see double-digit interest rates. I think you have short end of the yield curve moves up, perhaps significantly, perhaps upwards of 4 or 5%, but probably not a whole lot more than that. And
it's
remember,
that, though, that will change investor behavior.
Well, not by itself. Okay, so it depends on what happens on the long end of the curve. So right now, you have the Fed talking about, okay, we're going to start raising interest rates. Well, they're talking about the short end of the yield curve. So you get an inverted yield curve.
We're almost at a flat yield curve now, aren't we?
Exactly. You get and that goes inverted at really low interest rates. If all they do is increase short-term rates and slow down their purchases, or go back to no purchases of longer dated maturities, well, that's no different from what we were coming into COVID. Okay, so we're not looking at 1980s style. We're looking at still 2% long-term interest rates. That's not high interest rates. If the if fiscal policy falls into line, that's an entirely possible outcome. The risk, though, is that fiscal policy doesn't change, and we keep on with all of these proposals of increased spending. If that persists, then the Fed will have to do more. They'll have to not only stop buying more, they'll have to start selling and pushing up the long end of the yield curve, and that's going to hurt. That, no doubt about it. But I don't think that's a likely outcome. I think with midterm elections coming up and all of that, and I don't think that even if there's no change in Congress, I don't think that there's a motivation there to make changes that are going to hurt, or to continue down a path knowing that it's going to hurt. So and we've seen them back off. With some of the Democrat senators saying, what, we're not 100% convinced all of this proposed stimulus is needed. And the conversation has started, and so it's. I think it's reasonable to assume that Congress is going to at least back off, if not, get fully into line.
So at the micro level, and what it means to an actual investor and what they'll end up doing in the markets, there is an inflection point where inflation and interest rates rise so high that the risk premium of investing in stocks or real estate doesn't become worth it anymore, right? So now, for the last handful of years, people have been going to the stock market. They've been going into real estate because that's really the only place where they could turn to generate any type of meaningful returns. Money markets, CDs, and bonds are effectively zero.
Right.
As interest rates rise, that's not necessarily the case anymore, and there is a point where they're able to generate enough of a return on safer investments that they don't want to put that money at risk. Do you think we could potentially hit that inflection point?
Yeah, but that's short. Isn't that short-lived? Doesn't there have to be a point where the risk premium reflects the return?
Yeah, well, then that happens, and in that scenario, that happens by prices coming down to the point where forward-looking risk premium, is reestablished. So, and looking at again, the 1970s, 1980s, I think you get a good picture of what could happen in that environment where your forward-looking inflation expectations start to go up, and there's no good solution for it yet, and so people are worried that interest rates are going to be high and stay high. And in fact, 1980s, I remember my wife's grandfather, back a long time ago when we were talking, he was bragging about how in the early 80s he had bought a 30-year U.S. Treasury bond at 14% coupon, okay, and one of the best investments he ever made. And so I mean, well, if you can buy a 30-year U.S. Treasury at 14% coupon, who's happy with the stock or the risk of being in stocks at an 8% expected return?
Right.
Nobody's going to do that. So you have to have prices of stocks go down to create a competitive expected return.
Do you think there are people in the market reacting to that potential risk today?
Yes, absolutely. And there are very smart people selling. Okay, there's no doubt about that. Okay, Jeremy Grantham, he's one of the investors who, I don't agree with a lot of what he says, but when he speaks, I listen. Okay, I'm curious to hear his perspective, and he's looking at the future and saying, okay, we've got environmental policy that is going to have a significant impact on the population and how we live. You have whole host of issues that he thinks are going to be very, very bad for investors looking forward, and so he's encouraging his investors to sell everything. Well, okay, there's if those predictions come true, that would probably be the right response. But that's a really big if. What if they don't? And that's there's a bit of a stretch there. So I'm certainly not as confident as he is in those conclusions. So I lost the question.
I honestly think at the end of the day, you can talk to 10 people and get 10 completely different opinions on this one. Everybody's outlook will be a little bit differently. There are legitimate arguments that I'm seeing out there supporting a bear market that we're about to enter. And there are very legitimate arguments that I'm seeing out there supporting that the bull market will continue, prices will only continue to rise, we'll hit new peaks. And I could understand and argue both of those positions. At the end of the day, though, you just don't know what's going to happen.
Well, and in fact, I'm going to add to that and say that's actually one of the things when I'm looking at the market and saying, okay, forward looking, we talked about, be greedy when others are fearful, and fearful when others are greedy. The contrarian mindset. How do we know, in terms of our long-term outlook, whether, things are, whether it's time to be greedy or fearful? It's not because we have a prediction of what markets are going to do next year. We have no idea. But as we're looking at the long term, when there's an overwhelming optimism, be careful. When there's an overwhelming pessimism, time to fight that urge to sell and say, okay, what's everyone missing? And then there's the rest of the time when there's just widespread disagreement. I look at that as the Goldilocks, okay? When you've got 50% of people saying doom and gloom and 50% of people saying, hey, things are going to be good, well, now there's risk premium, okay? Now there are buyers, there are sellers. That's a functional market, okay? It's when everybody's on one side that you want to be the contrarian. Right now it's just a hold market, in my opinion. There's never been a time when you couldn't look forward and see doom and gloom on the horizon. Never, okay? Whether it's geopolitical risk or inflation risk or any of these factors, they've always been there, okay? And they always will be. There's not going to be a time when we look forward and say, okay, everything's finally good. And if we do, then there's some risk we're not paying attention to.
And for the people that are investing, all of that is irrelevant.
Right.
Because you create an asset allocation, and we're going to beat this dead horse constantly. Right. You create an asset allocation and you stick to it. But when your focus is hypersensitive to the news, what's happening in the geopolitical environment, what's happening in the interest rate environment, and it triggers you to make impulsive decisions, that's not investing. Now you're gambling.
Right.
When you are hedging your option strategies or you're investing on margin and you're taking these big bets on these big companies and you're using leverage in order to do it, that's highly speculative. And that's where a lot of people kind of get jammed up. And for the investors that have been investing for, actively for probably the last 10 years or so, they haven't really seen a point of diminishing returns that really pushes their boundaries of their discipline and causes them to make, the right versus the wrong decisions. And, everything that Jerry's been touching on, at the end of the day, when I think about how does any of this affect how I invest, it actually doesn't, because I can't control any of these things. Right. I simply can't, but I can control how much money I have in cash, how much money I have in stocks, how much money I have in bonds, how much money I have in real estate, and based on how those fluctuate, that will dictate my decision, not necessarily, what's happening in Eastern Europe per se.
Right.
One of the topics you touched on, that I'd like to circle back to, if you'll allow me to be just a tiny bit technical. When we talk about the risk premium and how, at what point, have interest rates risen enough that stocks become unattractive? And one of the indicators that we watch is the yield spread between dividends and treasuries, and yield spread between dividends and triple B rated securities. And when that spread is positive, when there's an excess dividend yield, above what you could make in bonds, that's a pretty good environment. That means there's an opportunity to capture not only that dividend yield spread, but also the growth of the dividends on equities. There was a long period of time, and from the 90s through the early 2000s, when that yield spread was negative. Okay, it was you could do better in bonds in terms of interest than you would get in dividends. It was counting a lot on the growth of stocks to make up that difference. Well, since 2008, that yield spread has been positive. You can do better in dividends alone than in bonds. So that's just one thing. It's one of many data points to look at. But when we talk about relative pricing of securities and how the market as a whole is priced, a lot of people talk about PE ratios, and a lot of people say how PE ratios are not relevant, because of the change in the inflation picture and the change in interest rates and things like that. And so historical PEs are not a good indicator.
If you look at PE ratios alone, I think we're at basically that point right before some of the biggest recessions in our history right now.
Oh yeah. PE ratios are definitely elevated, and PE ratios, I disagree with those that say that they're completely irrelevant. They are relevant in their proper context. They tell you what your expected, forward-looking return is. Okay, they're very informative. But in terms, when we look at, okay, do I buy bonds? Do I buy stocks? Where do I invest long run? Well, if I can buy a 30-year treasury at 2%, or I can do 8% in stocks, well, that's 600 bips of yield or risk premium. Is that good enough? That's the question that an investor needs to be asking themselves: is, am I being well compensated for the risk I'm taking? And in the long run, there are very few people out there that have figured out the mysteries of the psychology of the market and can time that, and they guard those secrets militantly. Okay, even the people working in their firms don't know what they're doing and why, and they're sure not going to share it with you. So the people who are coming out and saying here's how you do it, well, those are the secrets that don't work anymore. That they're willing to share now. They're making money off of telling it, because the strategy doesn't work. It worked in the past, but so for most of us, that's going to be a losing game. Okay, that's trying to time those purchases and sales. But looking at it with a long lens, saying, okay, not what do I think stocks are going to do tomorrow, but what are they going to do over the next decade? Well, that's a whole lot easier to predict, and you can have a lot higher confidence in those kinds of predictions.
And it'll be less stressful.
And it'll be a lot less stressful, and that's where what you were saying comes into play. So when we look at it and say, okay, should I own stocks for the long run? That's the conversation that you want to have. Is there enough risk premium there? Would I rather make 2% over the next 10, 20 years, or would I rather make 8% over the next 10, 20 years? What if I'm wrong? What's that do to my cash flow? What's that do to my lifestyle? Can I sustain a 3, 4, 5, 10-year downturn that happens? Do I have the wherewithal to stick to this strategy? Then set that strategy and act on it. And that's where the financial advisors can be very, very helpful. And probably the single biggest value that you get from a good advisor is
talking you off the ledge.
Yeah, helping you set that strategy, figure out a strategy that you can actually, avoiding the temptation of getting yourself into a problem where, okay, 8% or 2%, well, let's just do everything in 8%. Well, what if you can't make it through, a downturn? You touched earlier on the forced sellers. That's where they come in, and that advanced planning, making sure that you have a strategy that you actually have the means, or the risk capacity is the language that they use. You have the ability to take that risk without having to make major lifestyle changes that would hurt. That planning helps you set that strategy, and then sticking with it for the vast majority of people is the absolute best way you can invest.
And it's hard. I mean, it is really hard. When you're on a bull market run and stocks just keep increasing and keep going up and keep going up and keep going up, it is inevitable for you. And I've done it, and I've talked to Jerry about it. And my wife's talked to me about it and said, why are we sitting on cash? Why are we sitting on a bond holding, and we're losing all this potential return because we're not putting everything into stocks? Right. And that's really hard. Right. And that kind of discipline really challenges you in many, many ways. And I think it's easier for people that have been through a recession to see the value of why you do something like that. It has a purpose and it has a reason. And even if you're very young and you're looking for maximum growth and you decide to go 95-5, between stocks and bonds, keep your 5. Set your asset allocation based on what the goal and the objective is for the money, not because you're trying to chase a return. And like Jerry said, stick to it. And if you're getting close to that edge and you think you're about to jump, that's where a financial advisor could, absolutely help you.
So, look, we kind of just threw this thing together. We were talking about, inflation in the markets, and then thought it might be valuable for everyone watching. I hope it was. Please leave it in the comments. Let me know if this was interesting, of value, and if you want us to do more. And again, thank you guys, and we'll see you on the next video.